Chris.
Okay, everybody took your phones off?
Oh, wow.
I know you do, Jay. All right, good morning, everybody. Welcome to the November 20th meeting of the Merrimack Trustees of Trust Funds. First item of business introductions. I'm Chris Christensen. To my right is,
Jack Balcom, board member.
to my left,
Bill Wilkes, trustee.
and
Tom Bolin, Treasurer, Town of Merrimack.
attending by telephone, we have, who do we have? Judy Knoll,
Judy Noel, Cambridge Trust Company.
Eric Jusome, Cambridge Trust.
Lindsay Donovan, Cambridge Trust.
Okay, thank you very much. First order of business is the minutes of October 23rd. Do we have a motion?
I would motion that we accept the minutes of October 23rd as presented.
Second.
All in favor?
Aye.
Motion carries 3-0-0. Next order of business, we have Paul McKaylee, the Finance Director and Assistant Town Manager for the Town of Merrimack. And he's gonna describe some stuff to us he gets from DRA.
Thank you, Mr. Chairman. Good morning, everyone. During the tax rating setting period, DRA, our auditor, came up and asked me about a couple questions on the MS9. And it appeared that while technically the form was correct, it makes it very difficult for them to audit what the warrant article for deposits into capital reserve funds were. I believe there's a column on the MS9 that states income into the fund. And that first column for income into the fund should be what the taxpayers or residents of Merrimack vote in. For instance, if I give $400,000 for my highway capital improvements fund, capital reserve fund, that column should show $400,000. There's another column they said for interest that would be a separate column so that they could verify that the warrant article for $400 is there, and then the interest earned is there, so your total income is correct. If that is not working, because I know you guys spent a lot of time with Axiom, which is the vendor that DRA uses for that MS9 form, if that is not correct, then they need to get back and try to fix it. So that's what DRA said during the tax rate setting period about the capital reserve funds and what they noticed on the MS9.
Okay, simple enough. Thank you very much. I want to point out that income usually goes on the income side of the ledger, whereas contributions to the fund are on the principal side. They set up the form.
Right.
So, and I will also mention that at a meeting of trustees of trust funds held by the Municipal Association, there was a general dissatisfaction with the new format. So it's cumbersome for all of us. In the meantime, Judy, did you guys copy all of that?
I copied some of it. I wasn't able to hear all of it, but I can follow up with Paul and Tom if you'd like.
Okay, simple enough. Are they expecting us to go back and redo
No,
this year's MS9s?
no, they are not. Basically, I was able, once I saw what was happening, I kind of figured what was going on. I ran a quick report out of my finance software, and I saw what was going on, and I explained that to them. and told them that this is what was happening. And she was able to write a note in, and she asked us to change it for next year.
Okay, good. Thank you very much, Paul.
Did they indicate that they were seeing this with other towns, or?
I did not ask that question at the time. I was just concerned with trying to get a tax rate set because we were, as you know, November 20th, and I was just trying to get the tax rate set, so I wasn't really trying to figure out if other towns were having the same problem, if it was a DRA problem, but she said that that was the first time she saw it in her setting her tax rate, so.
Okay, because I would point out that Cambridge Trust, as well as doing some of this stuff for us, does it for several other towns as well.
That's why I'm bringing it forward, and I think it's a issue where we might have to get their vendor back involved.
Okay,
Because if we had the issue, I know that Cambridge Trust does this for several communities.
okay, anybody else have further questions or discussion?
Nope, I'm glad we don't have to go back.
Okay.
Well, thank you for giving me
Seeing
the
none,
time
we'll
of
move
day.
on. If you would like a copy of the upcoming presentation, Paul, and hang around, we have an extra copy.
Actually, I have another meeting to attend, but thank you for the offer.
Okay,
Thanks, Paul.
Happy Thanksgiving, everyone.
You too.
thank you, sir.
Thanks, Paul.
Okay, next item of business is the presentation of the review of our portfolio from Cambridge Trust. Judy, I'm going to turn it over to you. Can you hear everybody here okay?
Yeah, I can hear everyone fine.
All right, you're good. There's a little bit of a fuzziness to it, but it sounds pretty good, so press on.
Okay. All right. Well, I had Federal Express packages to everyone's home for the with the presentation material, and then we prepared a slimmed down version of the presentation that only included the investment performance for each of the accounts. So I'm going to turn it over to Lindsay and Eric, and they can walk the trustees through the information.
Okay, thank you very
Sure,
much. Eric, I'm going to interrupt just for a second. Historically, when we've had this meeting, you've sort of given us an economic overview. If you want to do that before we dig into the page flipping, that's fine. If you're just going to go to the prepared documents, then that's your choice.
I'll give an economic overview, and then we'll focus all of our discussion will be on the small presentation. I think it's about 15 pages, just the account performance. But if questions come up, we do have access to the bigger book that was mailed out as well. So I'll just spend a little time right now talking about the economy, because I think it's important, especially talking about market returns right now, that hard to believe, but the S&P 500 is up almost 11% through yesterday, and it's up 40% since March 31st. So an incredible rally in the market, but it's not as broad-based as those numbers would indicate. The S&P returns being up 11% are being very well dictated by technology, and especially the FANG return. So if you take, the 500 stocks in the S&P 500, you factor in those top 10. Those are the top 10 that are really leading the charge. You look at Apple, Microsoft, Amazon, are all up 30+% year to date. So it hasn't been as broad-based as one would expect. And one of the laggards has been dividend-paying stocks. And more value-driven stocks, which have really underperformed the broad-based growth stocks, and it's been one of the largest margins of underperformance that we have seen. And I'm saying this to bear in mind when we look at the equity portfolios or the sleeves of the equity portfolios, those are more mirrored towards dividend-paying stocks as mandated by the mandate of producing income. And even though the returns are lower than the broad-based S&P against more comparable benchmarks of like income-producing benchmarks, the performance is actually much better. So it's not so much stock picking; it's more that style for the last year has been out of favor. And interesting to note, since the election or a little bit before the election, there's been this rotation back into value. But even so, that rotation back into value has been more in that deep discounted value. So you've seen a rebound in airlines, as well as some of the cruise lines and hotels that really led the charge, since the election. Mostly on the fact that, obviously we've seen the better news coming out of both Pfizer and Moderna, as well as AstraZeneca yesterday. Pfizer today is applying for the emergency use authorization. So we could actually have a vaccine distributed to about 10 million Americans by the end of this year. So, you backtrack back towards April and May, and, that was the hope that we could have something within 12 months. So Operation Warp Speed seems to be successful. We will have a vaccine available by year end and ramping up production as we move through first and second quarter next year. So, the markets have rebounded and have really priced in, that Goldilocks scenario that, by next summer, next fall, we're back to a normal life, back to normalcy, which will be great. There are some skeptics out there via the bond market, which really haven't seen interest rates move dramatically higher. They moved up since the, post-election, but they've sort of come back in. Seems like every time we see a bump up in interest rates via the Treasury market, you see foreign buyers are coming in. You still have about $15 trillion of debt that's trading negatively on a global basis. So anytime, there's a buying program, U.S. government debt is still positively sloping positive yield. So you see tremendous buying pressure come into those markets. And I'd be remiss in saying, the Fed has, in Fed, and not just the Fed, but globally, this has been unprecedented amounts of global stimulus. We've got record low interest rates across the globe. You have a tremendous amounts of fiscal stimulus as well as monetary. So it's really been unprecedented, the amount of money that has been thrown at this pandemic to try to keep these economies afloat. And I think a lot of it has been successful. There's a little bit of news coming out last night or yesterday from Venetian that, the primary and secondary as well as the municipal market facilities will end at year end. Those have really helped prop up the bond markets for the, since Q1. But, if the economies continue to rebound because of a vaccine as we move through 21 into 22, then, more than likely those facilities may not, especially on the corporate side, may not be needed. And the municipal side, they really haven't been used that much. The lending terms are, the rates are a little higher, too high for a lot of municipalities. So that program hasn't been as successful, but, the primary and secondary market facilities for corporate bonds have been very, very successful. But overall, if you look at, economic activity from the lows of Q1 have moderated GDP growth, especially in second and third quarter, annualizing closer to 30% returns. Those are unsustainable. It's again, it's looking more like a V-shaped recovery. But again, that V will, how high that V goes, if we turn into a W or an L, will depend upon, the successful implementation and how fast we can get the world vaccinated. So, as far as, overall asset allocation goes, we had our asset allocation meeting yesterday, and we're moving our equity allocations towards neutral, towards our, equity targets. So if your portfolios, we're targeting growth, which is what we determine to be 70%, and the other one, moderate growth at 60. So we're slight underweight in a couple of in those accounts. We're moving those more towards those neutral weights. And that's more of our outlook base for 2021, where we expect, higher returns from the stock market compared to the bond market. We're expecting, more mid to single high digit returns in the equity markets. Comps are looking more favorable heading into 2021. Earnings estimates are expecting to continue to grow, especially if the vaccine comes in. So, we're more optimistic on the equity, having better equity returns in 2021. And bond returns, you're probably going to earn your coupon, especially, it's hard to see a scenario where rates move dramatically higher from here or actually move dramatically lower. So, we think, the bond, again, you're buying a bond for, protection and safety of principal, and those facets are still there. Especially funding rates are anchored towards zero with Fed policy. As I was talking earlier, that zero interest rate bound, as indicated by the FOMC, will probably continue through at least 2022 into 2023. So short rates will remain low, and you move out to the 5 and the 10-year part of the yield curve, and that's more reflective of growth and inflation. There's been some talk of inflation, but CPI is still running low. The Fed's preferred measure, the PCE, is well below its 2% target. So, the Fed has indicated, they want the economy to reach full employment inflation to reach 2% and maintain 2% for a period of time. That period of time, they have not specified how long. And if you look back over the last 20 years, we have not had very elongated periods of 2% inflation in this country. So, 2% is debatable if that is the right number, but, that is what the Fed is targeting. So short rates will remain low. Long rates may move marginally higher, especially if we see growth coming back faster than what's currently priced into the bond market. But inflation is not really a problem. If we look at, the break-even spreads on the 10-year treasury, on the 10-year, again, that takes the 10-year treasury, subtracting out the 10-year TIPS yield, and you're looking at, about 1.7, 1.75%, again, well below the Fed's 2% target. And as I was talking earlier, in negative interest rates, if you look at the current TIPS yield curve, it's all negative. So we are not buying TIPS right now to put your negative yields in. You really have to see rampant inflation in order to make those work. So I think overall we're a little more optimistic, especially with the vaccine news coming from Pfizer and Moderna as we head into 2021. Anticipate, marginally higher returns coming from stocks via the bonds. Bond returns probably being, lower than what they were this year. I think this year was a surprise, obviously with the tremendous drop in interest rates. It started by the Fed. The 10-year Treasury's down, has declined about 100 basis points, so most spots on the curve are down 100-plus basis points. Hard to generate much positive total return from there. But again, more earn your coupon in this low interest rate environment. So I think with that, unless there's any questions on the economy and our outlook for 2021, I will turn it over to Lindsay to run through the portfolios.
I just have one, let's call it a generic question. We don't own a lot of energy stocks, but some of them pay a pretty good dividend. I'm thinking maybe we should. Where do you see that market going, or that sector going, in the upcoming administration?
That's a really good question. We've actually reduced our energy exposure this year just for the simple fact there's so much ample supply on the market that it's hard to see energy prices move higher. And we feel, coupled to several energy companies, dividends may be at risk. So even though they're getting a higher yield right now, our feeling is that dividend yield may not be sustainable. So most of the portfolios right now, we have one energy holding, and that's Chevron. We had sold Royal Dutch and Exxon earlier this year at prices higher than when they are now. We've had a little bit of a rebound in energy, stocks in general in the last couple of weeks here, but overall, they're still significantly lower than where they began the year, and expectations are that it's going to be hard to see. Again, energy is such a small component of the S&P 500. It's about 2-ish+% right now. And, 10 years ago, that was about 10%. That just shows you the growth of the technology sector overall in the S&P 500. It's now about 28% of the S&P is tech. So even though those, Chevron right now has got a 7% dividend yield, that may get cut, especially as we move forward into 2021, where it's just very hard for these companies, to continue to operate in this low energy price environment, low oil price environment.
Thank you. One other question about the S&P 500. We compare our portfolio to that in some respects, but I'm thinking with the addition of companies like Tesla, the S&P 500 doesn't really match much of what our goals are. We're income equity, or equity income, more than we're growth, or we should be. And can you give us a little bit of a briefing on how we're doing, I guess, in looking at the S&P 500 when it may not really be relevant to us?
Yes, and that's that's a great question. It's a discussion we're having internally about equity income strategy of is the S&P 500 the right benchmark? And for now, we're sticking with it. Because if you move down to like the Dow Jones, Dividend Select, that has a very higher percent in utilities where, to make that switch, we would be, underweight some of the sectors of that market. So I think we're going to build out more of our, utilities analysis and try to, make it a little bit more towards like a Dow Jones Select, index. But overall, if you compare the returns of the three portfolios, the scholarship and the Merrimack Principal and Income, against the Lipper Equity Income benchmark, and those returns are much better. So, I think our positioning has always been not to reach for the highest dividend paying stocks. But, what our research shows is, stocks that pay a dividend, and we expect that dividend to continue to grow over time. So it's not a one-time hit, and all of a sudden, the company drops 50%, and, you're behind the eight ball. But, companies that, it's a growth and it's a dividend growth and income story as well. So, we're trying to get, current income as well as capital appreciation. And, so for now, we're comfortable with the S&P 500, but, with the caveat that that benchmark may change as we move through 2021 into 2022 to more of an income reflective benchmark.
Thank you.
Eric, I'm going to ask you this question. I was going to hold it until later, but I think it's probably appropriate to ask it now. I went through the big book that was sent to me in the mail, and I looked at it seems like I don't know who makes these decisions or what the thought process is, but there's a lot of transactions, a lot of buying and selling. Like, I see Microsoft purchased, I see Microsoft sold, I see Walmart sold. In some, none of us have a crystal ball, but some of these sales were considerably below what the price of the stock is today, and some of them were repurchased. I see Royal Dutch purchased, I see Royal Dutch sold within the year. We're not, myself, speaking for myself, but as a trustee, I believe in a more stable buy and hold type of strategy. And I see the bank is, kind of selling and buying some of the same stocks within 1 year. And I'm trying to understand what the philosophy is there.
Yeah, no, that's a great question. And I think a lot, the report we're showing is the year-to-date transaction. So if you look at the beginning of the year where, we started to see, energy prices were much weaker and, the attractive dividends. And again, this is pre-pandemic. So you look back in early January, I think back then, we bought Royal Dutch and then we sold it, at a loss. I think it was just more we weren't comfortable with having that big energy exposure in the portfolios, especially with declining oil prices. And, and I think that, that decision was validated as, energy prices have stayed low all year. And some of it is just, a little bit more portfolio repositioning as we went through the balance of the year. And some of it, some of the trades were, we were, bringing up that equity underweight a little bit in the middle of the year, where we were more underweight the benchmark than we were comfortable with in some of the portfolios, and it was more of a rebalance. So trying to, when we rebalance, we do it pro rata. So it's not just we're buying one stock; we do a pro rata distribution. So I think, in the scholarship account, there may have been some additional funds that came in that forced more of a rebalance. And if you look at the principal and income accounts, back in January, there was a little bit of trimming because we were overweight, which served the account well as we moved through the first quarter. And, I think if you look at the recent trades, it's been more portfolio rebalancing and repositioning of, I think, we're trying to add a little more cyclicality into the portfolio. You may see a little more industrials being added as we move through the first quarter of next year or late this year into the first quarter of next year. And also buying stocks, in sectors that are underperformed.
So let me interrupt. Let me interrupt for a minute. So I'm looking at your report here, and this is Microsoft. Microsoft is in a really good sweet spot, so to speak, right now with their technology, the cloud-based services, and a bunch of other products that are really in a sweet spot here. You sold it. So the settle date was 1/31. You sold it at 166, 45 shares, I guess is what that says. And you bought it in on May 21st. You bought 35 shares for $184. You sold it in January for $166. I think a lot of people would consider Microsoft one of the premier platinum stocks in the market today. And I just don't understand that type of transaction. Walmart, you sold it on 129 for $116. I think it's $150 now. A lot of people think that Walmart is going to really give Amazon a run for their money for a lot of reasons. So I don't quite understand. I mean, these transactions are all within 6 months. It looks like you sold all of Texas Instruments, which, that's a stock that I used to work for Texas Instruments, and they have fabulous products that are very differentiated and very proprietary. You sold that at 126, that's 160 today, or thereabouts. I don't understand some of these transactions. I don't understand. Can you just enlighten me on why you would do that with Microsoft, for example?
I think Microsoft is still a big holding within the portfolio, so it's still, it's still close to a 4 to 5%.
No, but you
weight
sold
within the
and you
portfolio.
rebought. You went through 2 transactions for almost the equivalent amount of shares. So what?
Yeah,
I understand rebalancing and all that, but it doesn't seem like you did any rebalancing. You sold and then rebought for a higher price.
Well, the rebalancing took place back in January, where we took some profits off the table right away in January for companies that had done very well in 2019, such as Microsoft, and we bought it back. Obviously, it was at a higher price, but the overall weight in the portfolio, we wanted to make it more of a bigger weight, and we agree with your assessment of Microsoft. It's still one of the largest. One of the largest weights within the portfolio. Same with Apple. We've actually trimmed Apple as well. So I think it comes down to, risk management within the portfolio of not having any single stock, being more than 5% weight within the portfolio. And that's our discipline of how we manage the portfolios.
Let me piggyback a little bit on that, because I'm with Bill in this perspective of some of it. And we had this discussion 6 months ago that we don't really care about locking in the profit. We're not a growth thing, we're equity income. We need the income, and selling good dividend-paying stocks doesn't do us any good. It doesn't matter that the price has gone up $20 or didn't go up $20. We still want the dividend. And if you're not going to grow the portfolio just by sitting on it, then I think your perspective is way too short. We should be looking at things in terms of years, not quarters.
Well, again, we typically do that.
I'm going to interrupt one more time. I'm disappointed because we brought this issue up 6 months ago.
Yep, understood. And, we've added more dividend-paying stocks to the portfolio. If you look at Broadcom, has a higher yield than Microsoft, has about a 3.5% dividend yield. So, that is, we're still continuing to add more dividend-paying stocks or higher dividend-paying stocks to the portfolio as well. And your point is very well taken on, short-term gains, long-term gains. But again, it comes down to, our overall, portfolio positioning of, not having, stocks run up to more than 5 to 6% of the overall weights within the portfolio, more for risk management standpoint.
Yeah, but that's not what this report is showing, risk management. It's showing that you're buying and selling some of the same stocks. It's almost, and don't take this as an insult, it's almost like you're being a Robin Hood investor. And I'm just curious and wondering, do you have people in your organization that just feel like they feel compelled that they have to make a transaction in a given day to show their worth? And that, again, it's not an insult, it's just an observation that, why do you do so much buying and selling? And some of it's within the same industry. You buy Royal Dutch, you sell Chevron. You buy Chevron, you sell Royal Dutch. I don't understand it. It just seems like somebody's just trying to stay busy or something. I'd rather them not be busy and leave the portfolio alone.
No, those are great observations. I will take that, these comments back to, my chief investment officer for the strategy of, not making this, have as much turnover, unnecessary turnover is, basically, what it looks like. And I agree. There's been a lot more transactions this year than we've had in prior years, and messages received, and I will relay that back up to my boss.
Thank you. We may have some other comments as we move along, but let's have Lindsay start on the portfolios.
Okay, great. I will start with the smaller packet that we sent out. On page 2, the Merrimack Scholarship account. Total market value for this account is $268,556. Current asset allocation is broken down 67.9% in equities, 19.8% in fixed income, and 12.3% in cash. It does follow an investment objective of growth, which, as Eric mentioned, we had been underweight that neutral 70% mark to equities, but we've recently discussed bringing the portfolios back to more of a neutral equity weight. The equity strategy that this portfolio follows is equity income, and the fixed income strategy is the taxable bond fund.
So let me interrupt there, Lindsay.
Yes.
I'm going to go back to the same thing that we said a couple of minutes ago. You're saying the strategy is growth, and 6 months ago, we said, no, it's not growth. It's equity income. We have a bunch of IT holdings that are basically dragging everything down. Maybe you think there's going to be some growth, but they're putting out a 1% or 1.3% dividend when we're looking for 3%.
That's absolutely correct. We define our investment objectives, so the asset allocation of portfolios, which is the breakdown between the amount of equities invested in a portfolio and the amount of bonds invested in a portfolio. We define those investment objectives as balanced growth, all equity, conservative. So that's what I mean by a growth objective. It's 70% within equities, 30% within stocks and cash on a neutral basis.
But Lindsay, so let's just carve out the equity piece that you're saying, the 70%, or in this case, 67.9% equity.
That's correct.
Of that equity, is it a growth strategy or is it a equity income strategy for that piece of it, the 67.9%?
It is an equity income strategy.
So you're working towards a higher dividend yield strategy that's obviously prudent and conservative. We're not looking to reach out to some of these stocks that necessarily, I'm not going to argue about the oil companies, Exxon or Chevron, but we're not looking to reach out to the highest yield, but we're looking to reach out to the ones that have a strong dividend yield, like Chris said, 3%, maybe a good target, and they grow their incomes, or they grow their dividends on a regular basis. There's a lot of companies out there. I can't think of the name of what they call those companies that are consistently growing their dividends. Those are the type of companies.
So the equity income strategy has a quality dividend focus. The stocks that we're looking to add to the portfolio have solid fundamentals that provide current income, consistent current income. So that is absolutely within the guidelines of what you've been speaking to. Quality stocks that also provide consistent dividends.
Dividend aristocrats. That's the term. And that if you look at that list of dividend aristocrats, I'm sure yourself and your people are well aware of that category. Those are the type of stocks I think that we're interested in.
Okay.
Thank you. Yes, as Eric mentioned, we'll bring this back to our Chief Investment Officer.
Okay, and you're saying equity income because we've been saying it, but your printed material says growth. So I think somebody in one place and someplace else says equity income. So I think there's a lack of focus here somewhere.
So I'm sorry to bring us back to that first page again. If you look under account information in that right-hand column, right above, so the very last row of that first section where it says account information, investment objective says growth, which is our asset allocation. It's purely an investment objective breakdown in terms of what from a portfolio gets invested into the stock market versus what gets invested into fixed income. If you go up 2 rows from that, where it says equity strategy, that says equity income, which is the specific style of equities that we're investing the portfolio in. As opposed to, we also have a strategy that focuses more on core equity, which would have more growth objectives. And we also have another one that focuses on sustainable and responsible investing. So you're absolutely invested within our equity strategy that focuses on equity income, current income, and dividends.
Okay, let's move on.
Okay. If we move on to page 3, looking at the performance details, on a year-to-date basis, the total return of the portfolio is down 58 basis points, while the taxable growth benchmark is at 3.38%. Looking at fixed income, the portfolio is at 3.36%, with the benchmark up 5.69%. Equities, the equities within the portfolio are down 1.9%, compared to the global equity benchmark, which is up 1.1%. As Eric mentioned, a good peer group for this portfolio is included on this page, the Lipper Equity Income Fund Index, which are other dividend and income-focused managers. They are down 9.02% on the year-to-date basis. We also have the S&P 500 included here, which is up 2.77% on the year-to-date. Moving on to page 4, looking at the Merrimack Water account. Total market value is $5,921,551. Fixed income is currently 67%, $3,969,000, with cash and enhanced cash at 33%, $1.951 million. This is a capital reserve account, so we are focusing on CDs and treasuries in the short term for this account. After earlier this year, when the Federal Reserve did bring down rates to their lower bound of 0, we did see a reset within CD and treasury rates. So they are quite a bit lower than they were when we entered this year. CDs, for example, we're currently seeing 6 12-month CDs in the 5 to 10 basis point range, with 2-year to 3-year in the 20 to 25 basis point range. Treasuries are also significantly lower than where they were last year. Currently, the 1-year is 9.5 basis points, the 2-year is 16 basis points, and the 3-year is 22 basis points.
Can I ask a question?
Yes, absolutely.
So I understand the CD rates, the short 3, 6, 9-month type of CD rates are probably in the range that you just quoted. But I've seen that a lot of banks, their money market rates are probably anywhere from 30 to 40, maybe up to 50 basis points. And that's an FDIC insured account up to $250,000. Why wouldn't you have some of the, do you put stuff into a money market account? I mean, to my thinking, it's federally insured, and it gives you a lot of flexibility in it versus sitting in a CD that gives you 5 or 10 basis points if you can sit in a money market fund at 30 or 40 basis points, you know, that's measurable. Can you just let me know what the thought is there?
Sure. So we do have a money market account within our cash portfolio. It's not yielding 30 to 40 basis points, but it is a very conservative money market that doesn't have any gates and fees associated with it, which is something that we look into. Another thing to look at when we're looking at money markets that might be offered,
Outside of your bank?
the rates aren't set for a long time period. So when we are looking at CDs, we were able to go and buy something at a certain yield that locks it in for an extended period of time. So the 20 basis points that we might be able to buy for a 2-year bond, that will yield 20 basis points for the time that the bond is held. Money markets are not, they are changeable. So when...
But if you lock in a 20 basis point 2-year CD, and you're in a money market fund, and then if rates move up, which is a possibility, in the short term, the money market is gonna move up, you know, some amount relative to the movement of rates. But you're sitting there locked into a 20 basis point 2-year CD, which isn't gonna change until it matures. I'm just wondering if that's a good strategy.
So the Federal Reserve has come out and said that they're unlikely to raise rates for the next few years, and money markets do trade off of the federal funds rate. I understand your point that it could increase and those money market yields could increase, but on the other hand, they could also decrease, and those rates could go down. So that is another point that we're taking into account here when we're reviewing different options.
I have to admit, this is kind of a tough market when you're talking the difference of 10 basis points here and there. One other question that I had mentioned in the email way back when we were setting up this meeting was that some years ago we used to invest in government agency debt, Small Business Administration, Department of Agriculture, other agencies that issue paper and it's still government guaranteed. And I haven't seen any of that of late. I'm just curious if that's something we should be looking at again.
Hey, Chris, this is Eric. It's something we can look at, but again, it's not, the problem you're going to have is a lot of this trades at premiums, right? And, you know, by the regulations, by the AG, you're sort of prohibited from buying premium bonds. So unless we can find it at the new issue, it's not a lot of that new issue paper around. You know, a lot of the portfolios do have agency debt via the Home Loan Bank, you know, Freddie, Fannie, but again, in some of those other, you know, I mean, I don't think we can buy mortgage backs for the portfolio because of the principal pay downs that happen. And even there, you know, you're talking maybe an incremental, you know, 5 basis point yield pickup. It's just the nature of the market in that front part of the curve where a lot of these capital reserve accounts where we're typically buying paper is there's very little yield. And, you know, you can move down into, you know, lower quality type paper. You know, the yield pickup is really not that great. You know, we talk about the principal and income accounts, you know, there we're buying corporate bonds where obviously the yield is much higher. And, you know, even there we're keeping the durations pretty much neutral to our benchmark. So, you know, I think we agree, you know, with the comments of, you know, rates are low. We're not reaching for yield in this environment. We don't think it's advantageous to do that, especially in the bond market. where, you can move out the yield curve, but again, you're locking in a 5-year piece of paper at, 50 basis points, where, your 2 or 3 year piece of paper is trading, 10 or 15 basis points, under that. So, we'd rather focus on shorter, higher quality names and keep the portfolio very, very liquid. And, we do expect at some point, probably, in 22, into 22 or 23, that the Fed will move into more of a tightening cycle compared to where they are now.
Thank you.
Yep.
If we move on to page 5 for the performance details of the Merrimack Water account, on a year-to-date basis, the total return of the portfolio has been 2.01%. Cash in the portfolio has yielded 39 basis points versus floater money markets of 40 basis points. And fixed income within the portfolio has yielded 2.65%. Versus the Bloomberg Barclays Government Index, which has yielded 3.05%. On page 6, looking at the Merrimack Muni account, total market value is $5,076,120. Fixed income in this portfolio is $3.8 million, 75% of the portfolio, and cash and enhanced cash is currently $1.27 million. 25% of the portfolio. Similar to the water account, this also follows the capital reserve investment objective. Year to date, the total return on this portfolio has been 2.02%. Cash has returned 0.44% versus money markets up 40 basis points. And the fixed income portion has returned 3.01% versus the Barclays government 1 to 3 year, which has returned 3.05%. Looking at Merrimack School on page 8, total market value is $984,000. Fixed income is currently $403,000, 41% of the portfolio, with cash and enhanced cash at $581,000, 59% of the portfolio. On a total return basis, on the year-to-date, the portfolio has returned 1.03%. Cash has returned 43 basis points versus the money market up 40 basis points, with fixed income up 1.68% versus the 1 to 3 year Barclays, the U.S. government, up 3.05%. Merrimack Income, this portfolio has a total market value of $3,397,007. It follows our equity income strategy. The breakdown of the asset allocation is currently 60% in equities, just over $2 million. Fixed income is 30.5% of the portfolio at $1,035,000. And cash and enhanced cash is 9.5% of the portfolio at $323,000. And the estimated portfolio yield here is 2%. On page 11, total return on a year-to-date basis for the portfolio has been 37 basis points versus the benchmark, which is 3.99%. Cash has returned 36 basis points versus the money market at 40. Fixed income is up 3.96% versus the intermediate government credit index, up 5.69%. Equities are down 1.04% versus the global equity benchmark, up 1.1%. But as I noted for the scholarship account, if we compare equity income to other similar peer group fund managers, the Lipper Equity Income Fund Index is down 9% on the year-to-date basis, which are other dividend objective accounts. Page 12, looking at Merrimack Principal, total market value is $4,863,458. This also follows a equity income equity strategy. The current breakdown on the asset allocation, equities are 67.8% of the portfolio, $3.2 million. Fixed income is 27.3%, 1.3 million, and cash and enhanced cash are 4.9%, $237,000. The estimated portfolio yield is currently 2.1%. On page 13, total return on the year-to-date basis is negative 2.19% versus the benchmark, which is up 3.38%. Cash is up 35 basis points versus the money market's up 40. Fixed income is up 2.57% versus the intermediate government credit up 5.69%. Equities are down 2.94% versus the benchmark, which is up 1.1%. The final 3 pages are our benchmark details, which I won't go through in detail, but they are there for your review. And that concludes the investment detail. So I will hand it back to you, Judy.
All right, well, thank you.
Thank
Chris,
you,
I know
Lindsay.
you wanted to have a discussion about the scholarship fund.
Well, I think we've had some of that discussion, but I think overall, we're looking for more income than we are growth. We made roughly $5,000 in income last year, but we gave out, and it depends upon which month you're looking at, and we're giving out almost all of that. But that doesn't give us enough income to increase the scholarship awards. And when we focus on growth, whether it's on the principal side or the income side, then that doesn't help us increase the awards. We really need more dividend income to increase awards and to make the increase sustainable. So if we take, for example, the Timothy Gibson Memorial Scholarship Fund, we've been trying to get to giving out $4,000 a year for a couple of years. We're doing $3,500, but we don't have enough income to sustain that, and the growth that comes from capital gains doesn't move us in that direction. Am I confusing that?
No, I don't think you are.
Okay.
It looks like the income yield on the portfolio is just under 2%.
Right. And 6 months ago, when we were talking about all of this, the income, the yield was, if I remember correctly, 2.89%. Now that may have been a more global number, but 1.9 or 1 point whatever it is really isn't an admirable goal. That's why we should be looking at 3%. And in my estimation, I don't know if the others agree with this, those IT stocks that are all doing 1 point something don't belong in this portfolio. And we got 10 of them.
Eric, do you have any suggestions as far as increasing the yield on the scholarship fund portfolio?
I'm going to take us back with our chief investment officer, but the overall equity yield on the scholarship fund is about 2.2%. So that's the dividend yield. And your point is very well taken, Chris, on the the technology stocks within the portfolio. we do have some higher paying ones in there, and, expectations are, some of these ones will continue to increase that dividend going forward. But I think you look at some of the, the recent purchases, like Broadcom had a 3.7% dividend yield. That was a recent add to the portfolio in 2021. So, we're trying to find more dividend-paying stocks, but again, we're not trying to, as was mentioned earlier, find, like the highest yielding dividend stocks, because we don't think those are sustainable. We bought Atmos Energy, a utility company that had 2.5% dividend yield. So I think, we're gradually trying to increase the yield. Honeywell's been, something we've been adding to this year. That's 2.25% yield. So, there's a couple of, the banking stock, Bank of America has a 3% yield. JP Morgan's 3.67. Again, those are bigger percents of the portfolio already. So we can, I think when we say it's a growth objective, that doesn't mean it's necessarily invested in growth stocks. Just mean it's the asset allocation for growth is a 70% weight to equities. We can, looking at the scholarship account right now, we have a little excess cash there. We could invest it into equities. It's going to get a higher yield than the bond market, unfortunately. You look at the dividend yield of the S&P 500, I think 70% of the stocks in the S&P 500 have a dividend yield greater than the 10-year Treasury. So if we're going to want to grow income, I don't think we should be growing it via the bonds, which would be the typical way to grow income in this low until we see interest rates move higher. The yields of a lot of these stocks in the portfolio are higher than the bonds. So I think, going forward, maybe we get a little bit more to overweight in equities and weight some of the stocks that have the higher dividends and give those a little more of a boost instead of doing a pro rata distribution to invest in additional cash. I think that would be, the way I would do it. Trying to, build the yield via these stocks. But again, you're taking on a little more risk if the market turns south. But again, your concern isn't so much market appreciation or depreciation. It's more the current income, which we can achieve by buying, add the weights to stocks that have the higher dividend yields and try to increase the yield that way.
So I don't want to pick on you for
That's the message.
individual stocks necessarily, but you mentioned Bank of America and I think JP Morgan. And then we have a third bank in there. I can't remember the name of it now. That's only paying a 0.7%. I'm sorry?
Was it Wells Fargo?
No. It's a regional bank. What's their attraction?
U.S. Bancorp, maybe?
First Republic Bank.
First Republic Bank, FRC.
Yeah, First Republic Bank.
What makes them attractive?
I think we anticipate, with the growth the company's been experiencing, that dividend will continue to grow. So it'll be a higher dividend yield going forward. That's our expectations.
Okay, I guess my sense of direction is to buy something that's paying the dividend now and has an expectation of growth rather than something that's inadequate and might grow.
Point is very well taken, but again, that's a smaller weight within the portfolio. If you look at Bank of America and JPM, those are bigger position sizes than what First Republic is, so I agree, and we can. I think when we get off this call, we're going to reconvene and do a little more portfolio repositioning to increase, with the cash that is there, increase, the stocks that have the higher dividend yields to make those a little more higher weights within the portfolio to, increase the payouts.
Sounds good.
You sold?
You had something to say, Bill?
No, I was just gonna say while you guys have been talking, I've been looking at the dividend aristocrats, and some of them are like Emerson Electric, Johnson & Johnson, for instance, and you sold those. And you sold them at a lower price. I don't know. I'm just not. I just don't understand the philosophy of how you. I think we've been clear on what our objectives are, and we're not talking about reckless behavior here. We're talking about blue chip companies that have been, in the portfolio, but now they're out of the portfolio, and we're not Robin Hood investors. And I know that's a mentality now, and again, it's not an insult, but I know that's kind of how people think, or a lot of people that look at the market on a daily basis, they trade for short-term gain, and I'd rather own Johnson & Johnson for several years than try to trade something for a few $100 here and there.
Message is received. So we're going to go back to not to the drawing board, but we're going to talk. I'll talk to our boss, and we will I wouldn't say eliminate the trading, but make sure that these accounts have been following what is our equity income strategy for trading, and I'm going to pull them out of the strategy so they won't necessarily get all the trades. And we'll do more of a one-off type situation if it makes sense to sell like J&J or keep J&J for the dividend yield going forward. Again, a lot of it would depend on what our prospects are for the growth of the company, and if there's a swap for J&J to another stock, I'm going to make sure that we're not going to be decreasing yield. For the sake of taking a capital appreciation to decrease yield. Message is very well received, and apologize for some, what looks like a lot of trading activity, but I think, it was a very volatile, period in the first half of this year. And, there's probably maybe too much portfolio restructuring that happened that was probably unnecessary. And, going forward, we're going to eliminate that.
And Eric, maybe we could look at some of these positions that have a zero yield.
Yield, exactly. I don't think there's too many
like
in there.
No, there
Yeah,
isn't, but like Walt Disney, that cut their dividend. So
Yes, Walt Disney cut their
we're at a
dividend, but again,
zero.
it had a 2+% dividend yield before it got cut.
Right.
So,
No, I understand that.
Yeah, and Visa that has a 70 basis point yield, and we could swap Visa into another higher dividend paying stock, like Watsco or even Honeywell. So I mean, there's some, at the margin we can increase the yield.
Okay, so
And TJX as well, there's no dividend on that. So that may have been another one that cut their dividend.
They cut their dividend, exactly.
You
So that's
sold
the hard part.
Texas.
Like a lot of these were companies that had a dividend, pre-pandemic that have been in the portfolio. So all of a sudden their dividend gets eliminated, or new expectations are that they will come back on. They will continue to pay a dividend, but in the near term, it's do we sell Walt Disney? For a loss to buy it back, as your point of, when it pays the dividend, in a year and a half from now, buy it back at a higher price, just, for the dividend, or do we hold on to it? That's a decision we're going to make internally.
You sold Texas Instruments, which has raised their dividend every year for the last 20 years, and it's up around, I want to say it's still over 2.5% right now, and you replaced it, hypothetically, you replaced it with something that didn't have hardly any dividends. So I'm just picking that as an example of going against the strategy, and we're beating a horse here, but it's another example.
Okay, so I think overall, we're not dissatisfied, but we think there can be a different focus or an improved focus. And I certainly want to say that the management and the returns on the capital reserve funds are better than what we might otherwise have expected in today's economy. So and that's where the bulk of all this money is. So we're kind of focusing on some of the stuff that's a different sense of direction than what whoever's setting up your overall perspective is. So I think we need to come back to this in 60 or 90 days and see if we've got some reasonable realignment and a better sense of what our goals are. So can we reschedule something for January, February?
But I'd like to see somebody put together a plan and not necessarily go and just oh, okay, well, Merrimack wants more income, and, okay, let's start selling, you know, to all these companies, and let's just get, I'd like to see more of a plan, like, you know, these are some of the companies we're considering selling because they're low income, and we want to replace them with, you know, the following 10 companies or whatever. I don't want to just see this be as a knee-jerk reaction.
Understood.
Okay.
So how would you like us to proceed? Do you want,
How about an email to all of us saying, hey, listen, we've reviewed your different equity positions, and we've looked at each company carefully. You know, we think we should keep Walt Disney because we think the dividend will return, and it's a very good company. But we think we're going to sell this regional bank because it does not fit your objectives, and on and on.
Well, Disney's a good example of why I'm a bit, it's a mixed message here. As Disney increases, you know, the yield's gonna go down, but the absolute income is gonna stay the same, and you're gonna have gains, which is also income. And to me, Disney's
No,
like...
That's the problem. Capital gains are not income for our purposes. If we were working on a total return basis, that would be one thing. We're not working on total return.
I mean, I love to see the value of our portfolio go up,
Right.
but that should be a secondary situation.
Yeah, but I mean, naturally, as it grows, the income's gonna go, I mean, the yield's gonna go down temporarily, but the actual dollars are gonna stay the same or more. Okay, I'm just thinking of how I would do it if it were my personal account.
Okay.
Yeah, we'll come back over the next several months here with, you know, with a, you know, before we do anything, with a proposal of, you know, what our trades would be and the rationale and what the effect to the income will be.
All right, I'm thinking, Judy, we can reschedule something for January or February.
sure. And let me just make sure I understand. This is only, we're only focusing on the scholarship fund at this point. Is that correct? We're not looking at the common fund.
I think the same philosophy applies to the principal side of the common fund, in the sense that the only way we can build the income side, which is money we want to give away, is with dividends. Capital gains don't add to the income.
Okay.
Until you sell it.
There's
All right, should we set a date for the next meeting?
There's a lot of high-quality companies out there. Some have already been mentioned that both grow from a capital gain standpoint and grow from an income from a dividend and income standpoint. You know, I think, again, we've mentioned some of them, but there's a, you know, you know them better than we do, and we're not in the business of, you know, speculating on a Tesla or you know, some biotech company that has no income that may or may not get the next whiz-bang vaccine or drug.
Yes, exactly. We'll come back and then you know, before the next meeting with some restructurings of the portfolios to show you what our thought processes are.
Okay, good. Thank you very much.
Thanks, Eric.
Lindsay, thank
Do
you.
you want to
Judy,
set
thank
a
you.
meeting date, Chris?
It says here on the
January
agenda,
22nd?
January what?
22nd.
22nd.
Okay. Well, we'll plan to attend.
Okay,
Yep.
sounds
All
good.
right. Thank you very much.
Thank you.
Have a
Thanks.
great day.
Okay.
Happy Thanksgiving.
Happy
Happy
Thanksgiving.
Thanksgiving.
Same to you.
Happy Thanksgiving. Thank you.
Bye-bye.
Bye-bye.
Bye.
Okay, that moves us down to correspondence on the agenda. We don't really have anything new, but I do anticipate that in the month of December, we will get some scholarship requests from the scholarships that were awarded last spring. So what I'd like is just authorization to pay scholarships as they come in, so that people don't have to wait until the end of January
Right.
when the school is sending out a bill on December 15th.
I will make that motion because we can't really have to vote on everything if we have no December meeting. So I move that we give you the authority to go ahead and pay those scholarships.
Okay, thank you.
I will second it.
Okay, all in favor?
Aye.
Aye. 300. Upcoming meetings, we talked about that just a second ago. January 22nd would be our next meeting?
Yep,
Is that good for everybody?
that's
You
good.
might be a telephone attendee, Bill?
I might be a telephone attendee. TBD, I haven't committed this year because of the whole coronavirus thing. But I'd like to be a telephone attendee.
Maybe we'll have a change of venue and we'll all go to Florida.
Yeah.
And then presumably February 19th, yet to be confirmed.
That would work for me, though.
I'm not sure, well, no, that's a Friday, so we don't have to worry about Monday holidays. Do we have anything else that we need to talk about? Tom, do you have anything?
I do not.
I just want to make one comment. I sure hope that the message that we sent them resonates, but I would hate to see us go with less stable companies that have higher yields.
I don't think we're talking, I'm personally not talking that way, Jack. I'm talking about Walmarts and J&J and
Well, yeah,
and
good solid
AT&T and
companies.
Bank of America and, maybe even sprinkling in Chevron or something like that. I'm not talking about, going out there and trying to get some company that can't even cover the dividend, but they have a good, great yield for today. I mean,
Yeah,
I'm
I'm
talking
sure
the
that's-
blue chip McDonald's Corporation, on and on. I mean, there's Emerson Electric, there's a bunch of companies that pay great dividends, that are strong, stable companies that aren't really affected by COVID necessarily.
Oh, I'm on the same page as you. Yeah, I'm not talking.
I just have a feeling, and I said it to them so they know how I feel. I just have a feeling they have some MBAs sitting in front of desks during the day, and they say, "Oh, let's mix this portfolio up a little bit. Let's trade out of Chevron and let's buy Royal Dutch." And
I can see what they're doing.
That doesn't make any sense to me whatsoever.
They're profit taking, and
It's a game. It's like playing video games for
Yeah.
some of these MBAs. Sorry to be cynical, but that's the way I feel.
Don't you have an MBA?
I do.
I also have an MBA, so yeah. I think we all have MBAs.
So that's
Okay.
I have adult children that are, might have similar mindsets of some of these people.
Well, on my personal account, I like to lock in profits.
Okay, I need to, I got an urgent call there. If we don't have any other business, can we move to
Motion to
adjourn?
adjourn.
Second,
And it is 10:17.
do you need to ride home, Chris?